Hello. I am really excited to tell y'all that I am joined today by Michaela Powell and Jody Grunden, who I've had the pleasure of working with for a while now here at Summit Virtual CFO by Anders. So thank y'all so much for joining me today. We have a lot of really amazing content to dive into. I'll go ahead and preface this for the crowd that we are likely probably not going to get through every slide because it's just that good. So we're going to be diving into profit-focused accounting, and talking about 4 metrics that business owners need to watch. With that, looks like Michaela, you're probably going to have to switch to the next slide because it's not letting me do it. Oh, there we go. Now it will.
Okay.
I'll go back one. I'm the facilitator. Obviously, I'm Hannah Hood. If you've been here before, you've heard me say that I absolutely love getting to come and spend an hour out of my month with y'all, talking through some really fun topics. And so today, I'm really excited to be joined by Jody and Michaela. I'm going to talk through a few housekeeping items. We do have the chat and the Q&A enabled. I will be monitoring that throughout the webinar. So if y'all have any questions, feel free to drop those in and we'll get those answered live while we are on the webinar. And then, like I said, you are going to get a copy of the recording and these slides after the webinar is complete. So I want to give you all a little bit of background about who we are as Summit Virtual CFO by Anders. So in 2002, we started as a traditional CPA firm by Jody Grunden, who I'm joined with, which is really exciting, and Adam Hale, who you see in the picture, respectively. In 2004, they started offering CFO and back office accounting services. Realistically, they were ahead of the curve for our industry and being some pioneers in this space. And then in 2013, they became a fully distributed firm, again, ahead of that remote working wave. In 2022, Summit CPA, we joined Anders CPAs and Advisors, a regional accounting firm based out of St. Louis. They are a traditional brick and mortar firm. And so now we have merged and become a virtual CFO team within Anders and go by Summit Virtual CFO by Anders. So that's a little bit about where we are in the present. So like I said, I am joined by Jody Grunden and Michaela Powell. So Jody and Michaela, I'd love for y'all to tell the audience a little bit about yourselves before we dive in.
Michaela, go ahead.
All right. I am Michaela Powell. I am a virtual CFO here, just as Hannah said. I specialize with digital agencies, I would say. Most of my clients are in the creative space, and I love working with creative agencies. And then I am located in Indianapolis, Indiana.
So Michaela, it was kind of funny because we hired Michaela right out of college. She was one of our first interns and has been with us for a long time. So super happy to have you and being able to speak alongside you. But with Summit, I think Hannah mentioned it all. We started back in 2002 as a traditional accounting firm. In 2004, we created the concept Virtual CFO Services, and then we started marketing and focusing on creative agencies. I think we've got about 80 or so creative agencies that we work with on a regular weekly, monthly basis. And what we're going to be talking about today is the Virtual CFO Service is basically profit-focused accounting. We'll talk more about that here in a little bit, but it's something that we created a long time ago to help our CFOs make sure that we're giving a consistent service to clients. And what we found out is that clients loved it because now they've got a way to actually, manage their business a little bit more effectively. And so we focus on the 4 metrics. And again, we'll get into detail there too. So again, super excited about it. Hannah, it's kind of funny that you picked a great music intro, ABBA.
Mm-hmm.
I was like, wow, I don't think anybody probably knows ABBA. And
Hype music.
that was before both of you guys were born for sure. And no, super excited to have this. Is going to be a fun one. And like we mentioned, feel free to ask questions as you go along. We'll try to answer all your questions as we go through the presentation today. And then at the end, as Hannah did mention, we do have a pre-recorded. It won't be the recording of this presentation, but it's one exactly the same way that Michaela and I basically put together last May. So it'll be a good one to rewatch if you have any questions about it. And hopefully you do have tons of questions and hopefully get those answered today.
Absolutely. All right, let's dive into it. Like Jody said, today we are focused on profit-focused accounting. We're also going to go through some different metrics and tools that we use when we're talking about profit-focused accounting. All right, so the definition of profit-focused accounting, I am going to read this off of the slide, which is a sin in the world of presenting, I know, but I think it's just really important to kind of break down what this means. So profit-focused accounting is a system designed to help a client accomplish their financial goals by breaking down their revenue into non-financial drivers. Unlike revenue numbers, non-financial drivers can be consistently controlled and monitored through clear metrics that are then used to determine a client's revenue forecast. Finally, the amount of expected revenue in the client's pipeline is used to inform and adjust the forecast. So what does this mean? My favorite comparison is using ice cream cones for this. So if you were an owner of an ice cream shop, you could forecast out your revenue by how many ice cream cones you could sell every day. So if you can sell 500 and you know each ice cream cone cost $5, you can use that to forecast out how much revenue you can earn. You can also do this if you were at a doctor's office by saying how many clients can I see or how many patients can I see every day, how much is their average revenue, and then being able to forecast it out and not just say, I think I can make this much money every single month or every single day. So in the world of digital agencies, we normally use billable hours and billable rates as our non-financial drivers to build out profit-focused accounting. So the 4 metrics we are going to dive in today: cash, our production metrics, our financial metrics, and pipeline if we get to it. Normally I end up talking a little bit too much and we breeze through pipeline, but like Hannah said, we do have a recording at the end in case we are running a little bit long. Our first metric then is cash. So this is a fun one to talk about because I just feel like it makes so much sense and provides peace of mind for owners. So how much cash should I keep on hand? We're going to think of this in 2 separate buckets. So the first one is our cash reserve. So that's your 10 to 30% of revenue. So we're going to look at how that's calculated. And then we also have on the other side our tax reserve. So that's about 40% of our forecasted net income. So, oh, I didn't know, Jody, I heard you take a breath. I didn't know if you were going to say something. Just feel free to jump in with any comments or questions, of course. So diving into that cash reserve part of cash, how much should I keep on hand? We said that 10 to 30% of the last 12 months of revenue. So just looking at an example profit and loss here, if this example company was to make about 3.5 in revenue, we're just going to use that 3.5, about 10%, $350,000 in our cash reserve if they're at that 10% level. So how do you know if you're at that 10% level or 30% level? We really look at a bunch of different qualifiers, whatever that right word would be. So maybe you have a lot of high recurring revenue, so it's really predictable how much cash you're going to get in every single month. Or on the flip side, maybe you're mostly project based, so you don't really know how much cash you're going to get in, so that you might want to be a little bit more conservative with your cash. So you can see the different options here and kind of figure out where you fit between this 10 to 30%. I would say a lot of our clients try to strive for that 10% minimum, but I even have one client who's very specific and they want to be exactly at 15%. So that's what works for them, and that's great. I also think it's important to mention customer deposits when you look at the 10 to 30%. If you're receiving a lot of prepayments from clients, you also want to be on that conservative side, maybe closer to 30%. and have a little bit of extra cash if you're receiving lots of payments up front.
Yeah, I would say, kind of backing up a little bit, I would say that what is 10%? What is 30%? What does that really mean? And in financial advice, we say that, hey, you really need to have about 2 months of expenses to 6 months. 2 months is 10%. 6 months would be 30%. So if you're on the conservative side or you're risk adverse, then I'm going to say get as close as you can to that 30%. If you're not risk adverse and you're saying, you know what, we're going to churn things, everything's going to be great, nothing in the world's ever going to happen, it's going to impact my business, stay close to the 10% mark. So again, that 10%, 30%, it still gives you that 2 month to 6 month cushion that you have there. Another way to look at that would be, and if you're looking at with our client base, I would say our average client right now has about 17%. So Michaela's example was 15%, which is really close to what a creative agency typically has. And again, it's for those opportunity costs, right? And so we always tell people that, hey, if you were to ask me today and I looked at your financials and I said, hey, I want to hire this biz dev person that I've been waiting to hire forever. She is the perfect person. It's going to really help accelerate growth. The first thing I'm going to look at is your cash position. If you're below 10%, probably not going to say, I'm probably not going to give you the green light on that, saying, hey, it's too much of a risk to hire that person that you really didn't have budget or forecasted in your budget. However, if you're between that 10 to 30%, you're at 30%, 15%, somewhere in there, what we're anticipating, I'm going to look at those financials and the exact same financials. I'm going to say, yeah, great idea. Let's take that risk, hire that person, that opportunity that may not be there, later. So, based on where you're at in cash is how we look at and how we can give that strategic advice, or the strategic advice that you should be thinking about when making those decisions. How much cash I have in the bank determines how much risk that I can, take on clients, how much risk and I can, set aside if I'm thinking the economy is going to go bad, and do I need 10%, 30%, risk that if I've got a giant client that comprises of 60% of my business, I'm going to want close to that 30% mark in cash at all times. Like Michaela said, if I'm risk adverse and I've got a subscription-based billing model like we have, where we don't have an accounts receivable, well, then you don't need as much. That 10% is definitely good enough. And so you have to kind of look at your company and determine, hey, where do the scales, adjust for you? There's not a formula that's going to say, hey, yeah, you need 15.5% or anything like that. It's kind of more that gut feeling and that risk that you as the owner will be taking. So 10 to 30%, and we gave you some examples here on what might weigh the scale one way or the other.
So I have a question from the audience that I think this would be an appropriate place to plug in here. What advice or tips for making progress towards a cash reserve goal would you give to somebody who is just trying to make payroll each week?
Yeah, and
Yes.
yeah, if I may, real quick on that one, Michaela. That was our company for the first 10 years. Really, we were trying to figure things out. We're starting up, we bootstrapped the company. And so we were in that position for a long time. And that payroll is like, it just like gets you in the gut when you're trying to save money and you're waiting for that accounts receivable to kind of, come in, and, the timing is just not great. There's a couple things that I would recommend that we took into account. First of all, don't be afraid to take on, don't be afraid to give terms out to your clients, meaning, hey, if you pay today, you'll get a 5% discount, a 3% discount, something of that nature to do that. Keeping in mind that big companies, if you have enterprise companies as clients, a lot of times they're required to take any kind of discount you might give. So something maybe a lot of people didn't know. That's one thing that we look at. The other thing is getting ahead of your accounts payables. When you have a brand new client that you're onboarding there, don't wait to get that first payment before you actually talk to somebody in their payable department. You should reach out to them, make sure that everything is coordinated. Timing is great. They've got the right address. They've got the right payment information. They've got everything signed by legal. What you don't want to find out is you get going on the project, and then 3 months later, a month later, it's due. It doesn't come due. You wait for a few days because you don't want to, rock the boat at all, and then find out after 60 days that they never got the information that you needed. Now all of a sudden you're in that 30-day cycle. Now you're 90 days out. So it's always great to make friends with that accounts payable clerk. We highly recommend every brand new client of a certain dollar amount, reach out, make sure that they've got everything. They appreciate that too, because the last thing they want to do is chase things down after the fact. They want to avoid that, that big emergency that, hey, I'm not getting paid. And so highly recommend those two things. And the other thing, of course, is what we end up going to is a subscription-based billing model. If there's any way that you can incorporate that into your business where you have retainer clients where they have a reoccurring thing, that will help your cash flow dramatically. So those are the three things that I recommend. Michaela, do you have anything else to add to that?
No, those normally cover it, but I think that like tees us up perfectly for the next few things we were going to talk about with speeding up accounts receivable too, and just how moving a client from net 60 to net 30 helps so dramatically. So I'm going to go through some of these different cash accounts, so a little bit more of the logistics of what we want to do with our cash, but then we'll go right into that accounts receivable part of it. So this is just talking about, again, how much cash should I keep on hand, and not only how much should I keep on hand, but where should it be? So we have our operating account, our cash reserve, our tax reserve, and we also include a line of credit when we're talking about cash. This proofs out our cash flow cycle a little bit. So again, we just use that 10 to 30%. It's easy to calculate, but if you wanted to get into the nitty-gritty of the cash flow cycle and see how much cash you're bringing in every single day with the daily revenue and your usage, it gets us really close to the same as the 10 to 30%. So you can do it the more difficult way, or you can just do the 10 to 30% range.
I
whatever.
like easy, where I can take
Yes,
easy.
that's what I do too. I can calculate that one in my head. This one I am not able to do in my head. So where you should keep the cash, we like to say at least 2 payrolls in your operating account, and then the rest in your cash reserve. So almost like a sweep account if you use that. So that's where your 10 to 30% of your 12 months of revenue is going to be. But then, of course, we also have to talk about our tax reserve. So we have some question marks there that we'll talk about. And then this slide shows the connection or relationship between operating and cash reserve and also our line of credit. So our line of credit, we should also have the same amount available on the line of credit as we do in our cash reserve. So still targeting that 10 to 30% if we're able to. Ideally, you do not have that on your line of credit, but you have it available to you on the line of credit. But that kind of gives you just a benchmark of when you talk to your bank, how much you should ask for.
I want to also, while you were talking about those accounts, so
Yeah.
I feel like I've seen a shift towards high yield savings accounts being a buzzword whenever it comes to putting your money and making in an account and making sure that it's working for you, just as we've seen interest rates shift over the past few years. So at what point are you recommending to a client that they should start considering putting their money into a high yield savings versus just a traditional savings that keeps it pretty liquid and close to their operating account?
Day one. So high yield savings account. What Hannah's talking about is more so like American Express account, a SoFi business account, an Ally business account, that sort of thing, are the high yield savings accounts where they're earning 4.5% interest rate versus a traditional bank who's earning 0.45% interest rate. There's a huge difference there, and so we highly recommend and we break it down into the two different accounts, saying, hey, have a checking account, which is the operating account, which is the 2 payrolls. Yeah, we say 2 payrolls because, again, you can mentally calculate that in your head, and you know exactly roughly what you need in there at all times. The rest of it's going into this this high yield interest savings account. And it can be a CD, it can be a money market account. It's got to be something that's super liquid, but you do want earning interest, because as you get bigger and you're at a 3 million, a 5 million, a 10 million, a $20 million, that's a lot of money. 10% of 20 million is a lot of money to have just sitting around not earning money. So it's important that that money is making money. So from day one, highly recommend opening up a Schwab account, something that's going to have that high interest account that you're not going to find in a traditional bank, that you can sweep back and forth the money. Other folks, right now is not a bad time to actually have a CD. Maybe it's a month CD, a 2-month CD. Maybe you ladder it a little bit and have it ending on different dates, in different dates, so you're constantly renewing it. Something that you can get to fairly quickly without penalty is the key here. And so as you're growing it, I know it's super tough. I know the one person said, hey, I'm struggling even getting that. Once you do get there, then you want to make sure that you're actually making money on it and putting it in there. Don't put it in anything that's going to be risky, like the stock market, bonds, that sort of thing. Keep it completely into something super liquid, because you're going to be moving money in and out of it pretty much on a regular basis until you get to a point where you can actually start accumulating some funds there. So again, we recommend having the two accounts, the cash reserve, the operating reserve. We talked about the line of credit. A line of credit, I would highly recommend getting it when you don't need it. That's the best time to get a line of credit, or get a line of credit when the economy is the best versus when it could be bad. And so if it's going, if you think, hey, we're going to be in a recession in 3 months, 6 months, probably now's the time to get one. You don't want to get one during a recession. Obviously, that's not going to work out. The banks aren't going to do that. But also, I would say always get a line of credit that's renewed every 2 years, not every year. So pay a little bit more, get a 2-year renewal. Majority of banks will offer that, and that gives you even more time. That if we do go into bad times, recessions typically last 9 to 12 months. Somewhere in that ballpark. You'll have that line of credit for a period of 2 years, so it should cover you through that time of uncertainty. So again, highly recommend those. And then Michaela's going to talk about the tax reserve, which again is a separate account outside of the cash and the operating reserve, and that's based on a future forecast. And we'll talk about how to create that future forecast here in a little bit. So, Michaela, if you want to take it to the tax reserve and go from there.
Yes. So looking at the tax reserve, so this is the account that we're saying should be around 40% of your net income. So this time we're looking at the bottom line, not top line revenue. So for this example, if this client's net income is around 655,000, their ideal tax reserve at the 40% rate would be around 262,000. So the 40% is us being very conservative. Obviously, everybody's tax rate is a little bit different. Your circumstances change, but we try to stay on that conservative side. So that's kind of why we recommend 40%. So this shows if we break up that 40% of the 655,000, that's about 60. If we break it into 4 transfers, that's about 65,000. So if we make it a goal to move 1/4 of our tax reserve to a separate account every single time an estimated tax payment is due. So we move 65,000 on April 15th. Then we pay the estimated tax payments that come from your tax accountant. So if it's a $50,000 estimate, we've moved 65,000, then we pay 50 out. Then June 15th comes around, we move another 65,000, 50,000 comes out. So you can see as the year progresses, we end up with an estimate of how much we think we'll need before we owe taxes on April 15th. We're ready to go, no stress. We're not wondering how we're going to come up with the cash to make our tax payments.
Yeah, and it's important here that you're not sending that forecasted money to the IRS. So as you noticed, she said, even though we're forecasting to have, a tax at the end of the year owing 262,000, this example, we're not sending that full amount to the IRS. We're only sending the amount that the tax accountant gave you on the little estimated payments or coupons they gave you at the end of the year. And so in this case, we're assuming that you're going to be growing and this year is going to be better than last year type of a scenario where we've got, forecast revenue higher than what we actually had. And so the key there is only send the minimum, because what happens is in that third quarter, if things go south, we may have to dip into that cash reserve or that tax reserve. Plus, that also means that your forecasted net income is going to be lower and your tax liability is going to be lower. If you send it ahead of time, you're not going to be able to get it back until, April 15th of the next year or so. And so that's why it's important to only send the minimum and then adjust it significantly in the last 2 quarters based on, where you're at. And so again, we're only making the minimum payments. We're building that that tax reserve. So again, no surprises like Michaela had mentioned at the end of the year.
Perfect. So this kind of wraps up where cash should be then. So again, your 10 to 30% of top line revenue between your operating and cash reserve. Then you have a third account set up for your tax reserve, and that's where you're making estimated tax payments out of and also moving those savings into maybe every quarter. And then you also have your line of credit as another backup and you should have about 10 to 30%. and you're available on your line of credit.
So I
So
had a
now,
client,
oh,
I want to tell a
okay.
story about a client with their cash reserve. So I had a client once
Yes.
who we had the conversation every single week, like we need to set up a cash reserve. We need to do it. We knew we had this really vulnerable thing that might happen in the future, and we needed to be prepared for that from a cash position, but he never would actually do it. So what I started doing in our cash flow meetings is I started just playing out what $10,000 a month, $10,000 a week looked like coming out of his account, so that way he could see what the bottom line was after all of our forecasted expenses and inflows. And it was, for him, it was like, oh, okay, like I can do that. I can take that money out of sight, out of mind. And so then I just incrementally started adding more each week to that. But that really did help baby step us into the thought of, okay, I will be fine if I go ahead and put this money aside and make sure that I have visibility into the future. It really made a difference in making sure that we had that reserve established. And now he's got well over $2.5 million in a cash reserve, because that's where it started. And he's had nothing prior to that.
Yeah, Hannah makes a good point. A lot of people, cash out of mind, out of sight is what you want to think about when you have, especially the tax side of it. Because what happens often is you look at that and say, well, I've got X amount of dollars in the bank at the end of the year. I'm doing well. I'm going to go out and make a big distribution and pay down some debt and personal debt, whatever. And in reality, you've got a tax bill coming up. And so the nice thing about by pulling it out and having a separate tax account and making distributions out of that tax account is that, again, it's out of sight, out of mind. You're always planning, you're always basing future decisions on what's truly in your cash account, not what's in your cash account plus the taxes that you're going to owe. Again, it's just more of a psychological thing that you don't really think about, but very important. More so, what Hannah was saying, we recommend taking it out on a monthly basis, out of your account, like you recommend. We've had clients that do it every week. Every week they pull out X amount of dollars because it's a smaller dollar amount. It's easier for them to digest, but it is money going into that tax account. Keep in mind that tax account you're gonna be making some money on, maybe ladding your CDs, high interest savings account, whatever, to make some money on that money. But it's also available there that if you need to pull out it, you can. That's a kind of a last resort account to pull money out of. If your cash reserve is already eaten up and your tax reserve, that's again available for you to pull out if you need. So again, out of sight, out of mind, really important.
So now we're kind of circling back to that, how to accelerate your cash reserve using accounts receivable. And this just shows, so this example would be if somebody's on a net 60 AR terms. So maybe in February they have 200, then they drop negative 300 or 30,000, if I can read numbers, in March, and then maybe they go up to 80,000 in April, 150 in May. If they would just change their AR terms and get cash in the door more quickly, you can see how much better their cash position would be. So this also is even better if you can somehow get it on a 15-day term. But just like Jody was saying, this really comes with the relationship building and setting that expectation at the beginning of the engagement. You don't want to be going back to them after you've worked with them for 6 months and changing their terms and asking for them to pay earlier. You want to set that expectation at the beginning.
Yeah, and you kind of see this is without actually invoicing an additional dollar amount. We're just collecting the money a little quicker. And so in this case, in March, where we may be typically borrowing on a line of credit of $30,000, we actually have an excess cash of 170 if you were able to get the terms that you need and want. And keep in mind that a lot of people say, well, they'll never give me that, or I can't get that. It's like, well, you can't unless you ask for it. And you'll find out, again, majority of clients, they want that discount, whether it's 3%, 2%, whatever discount you want to give to get a quicker payment on there is important. But I would say the biggest part of accounts receivable is just the consistency. If you're consistently following up, it's one day past the due, you're taking some sort of action, whether it's sending out a reminder email or whatever. 5 days, 15 days, you want to stay consistent. Do not wait for that first communication to be after 30 days past due. That's going to cause havoc with your accounts receivable. It's going to cause havoc with your cash flow. Make sure it's on a consistent basis if you're having any issues collecting on payments.
And I've gone through this with a client actually recently. Whenever they came to us, their average AR days in turn was about 60 days. So we said, okay, like we're feeling too much strain from a cash flow perspective. We've really got to dial this in. So we did a couple of these things. We have really honed in on our onboarding process for new clients, as they have some really good structure around setting up all their things with the client's accounts payable department. So they get that established up front. We did the 15 days. So everything is on net 15. Again, you don't know till, yeah, they had a couple people push back on it, but the majority of people were totally fine. They were just going based off of the terms that we put in place. So we implemented that. And then the other thing that we did is we got invoice out quicker. So speed was key for us here. So the invoices that we could set up to go out automatically on the first of the month, we set those up to automatically recur and go out on the first of the month. Whereas we only have a couple of them that we send out on maybe the second or the third, and then the next round of invoices on the 16th or the 17th. And that has, like, just those few little changes has made a dramatic difference in what we feel in the conversation that we're having in cash flow every single week.
Mm-hmm. Yeah, another one that I thought of is moving your clients to accepting only ACH payments if you can. Sometimes you always feel like you're just waiting for that check to arrive in the mail, and ACH speeds things up dramatically. So that could be another easy win. So we wrapped up our cash metrics. We are going to go into production, which is really where these non-financial levers come into play. So we're really digging into billable hours and billable rates. So what is the difference between your weekly expectation and your utilization rate? So weekly expectation is how many hours you expect to bill every week. So for a lot of agencies, it's either 30 out of 40 hours or 32 out of 40 hours. And your utilization is how many billable hours can you do? It's kind of easier to think about this over the course of the year. How many billable hours can you bill for how many working hours there are? So normally working hours is, 2,080 every single year. So that's when we had to start taking into consideration holidays and PTO, which we'll get into a little bit. So what is standard bill rate, average bill rate, and effective bill rate? Standard bill rate, this is what you tell your clients you're going to charge. So maybe it's that $180 per hour of work. That's what you are telling them that your rate is. The difference between standard bill rate and average bill rate is what are you actually getting? How much revenue are you getting for the number of billable hours that you work? So we'll get into it shortly, but we also have write-ups and write-downs. So if it takes you more hours to get, I'm trying to think of a good way to explain this. I love write-ups and write-downs because it tells the story so much. But let's say you have a project and you think it's going to take you 10 hours at $180 per hour. So that math, which I feel like I need a calculator to do because I'm an accountant. So if it takes you 12 hours to do it, obviously you have to write off those 2 hours. So your write-ups and write-downs are really telling the story of how much you're able to get per hour. On the other side, we have effective bill rate, and this is really for how many hours you're paying your production employees, how much revenue are you able to get. So it kind of takes into consideration your bench time and your capacity. So really tells a good story and is really helpful to look at month over month and compare your performance.
Yeah, and I think it's important that we define all the different definitions we're using, because there's so many different things out there in the world of accounting that we just want to make it very clear on what we're calling something and versus what you might be calling it traditionally. It doesn't make any difference really what the name is, but we just want to make sure that we're on the same page as we're going through and explaining how they actually apply to that revenue forecast that we're putting together. One person asked again, hey, how do I, what if I don't have the cash, to put in reserve and all that kind of stuff? Well, there's always a hidden reason behind that, and the hidden reason is the profits aren't as high, or your accounts receivable is kind of out of whack. And so we've already addressed the accounts receivable side. Now we're looking at the profit side to make sure that, hey, what we're going to build here is the capacity that your team has, and then what the revenue capacity is, what the dollar amount capacity is, what the net income capacity is for your team, and then that's what and that's the big part of the pipeline of the production, not pipeline, but the production metrics, and that's what Michaela's going to show you now. What should your team be achieving in revenue, and then we're going to hit the financial side, and what should it be hitting in the net income side.
And setting up this chart, you can absolutely do this for your own team. So all we're doing is all of the months across the top, and we're just going to figure out how many non-weekend days we have. So obviously it changes month over month, different number of working days across the top. Then we're just going to multiply that by 8 hours a day. So we're going to get our total working hours, which is where that 2080 came from when I was talking about utilization. And then we're going to add in culture hours. So culture hours are your holidays, your PTO, if you go on a team retreat, if you have internal working time that you want to build in and say we're going to have a little bit less billable time these months. This all gets you to how many available hours you have. I think there's another slide on a different one, but what's important to point out is your available hours varies month over month. So November and December are typically low just because of holidays and PTO. So it's just important to measure against your expectations every single month. Then we build in our weekly expectation. So for this example, we're expecting our employees to work 30 or to bill 30 hours every week, so 75%. So then we know what to expect for billable hours month over month. This really highlights the difference between expectation and utilization. And utilization is pulling out all of those company culture hours to get total billable hours divided by how many hours you could work, 2080.
Okay, I love that you pointed out like month over month the difference, because I think the percentages really highlight that, especially for November and December in terms of what we're looking at here. And so this is a large part of the conversation that I'm having, and have been having the past couple of months with my clients of like, hey, like we know naturally because of the things coming up, we are not going to be able to bill as much. What are we doing to be sure that we are prepared for that time frame, and making sure that we're having a proactive conversation instead of a reactive conversation around that?
Yeah, absolutely. I've seen it a ton with people taking PTO all summer long, where we keep thinking we're going to hit those billable hour goals, and we're like, oh man, they took too much PTO. But it's just understanding why we fell short and building in those expectations month over month. So now we have the hours portion figured out for our drivers. We're going to then look at our billable rates. So that standard rate that we were talking about $180 is what we tell our clients. Then we get into those write-ups or write-downs for our average billable rate. I would say a normal range for write-ups and write-downs. I typically see write-downs 5 to 10%, I would say. I don't know, Hannah or Jody, if you see something different, but I also have clients. I have one client right now who has a ton of write-ups, and we're trying to figure out why are they having so many write-ups? Why can they be putting in extra time into a project instead of just saying, well, we still had 20,000 we could have earned on this project, but we don't have anything left to do. So it's really, can we provide more value to our clients with that extra budget almost? And then I also have another client who's on the opposite end of the spectrum, and they're just trying to make sure they stay within the budget that they've set for themselves for hours, and trying to keep write-ups under 10%. And why are we losing efficiencies? Do we have too many people on this project? Do we have too many expensive people on this project? So it's really, it again tells the story beyond just looking at what was your revenue for the month.
Yeah, I would say that if you're wondering where my profit's at, it's going to not be in your admin or marketing costs. It's going to be right here.
Mm-hmm.
If you don't have, if you're not close to that 5% write down area, you're losing a lot of money. And it's typically like Michaela was saying, it's coming from project management. Hey, we agreed on this dollar amount, and hey, we can't, or this out the number of hours or whatever we're doing, and we can't hit that. We're going over it. Or it's going to be based on sales, where your salespeople are saying, "Hey, we can hit this number," not talking to the project management, and the project is doomed from the very beginning because it's really an impossible number for the team to actually hit. And so it's important to have that communication from the project management to the team, and from your business development to the actual project management. So those are the two areas that we see are going to be the issue. And I've talked to
Mm-hmm.
many different agencies over the years, thousands of agencies, and here is the biggest issue. If you see more than 10%, you've got some major issues you got to figure out. And it's very common for us to see brand new clients come in with a 20 or 30% right up, right down. And
Mm-hmm.
that's not that's or mostly write downs, and that's not uncommon. But you want to focus and get that, like Michaela's saying, get that closer to that 5% write down mark. The other thing with write ups, that Michaela did touch base with, if write-ups happen when you underprice the dollar amount to get the deal, and what you're finding out is, hey, you probably could have got more deals had you priced it appropriately, and that's going to
Mm-hmm.
cause write-ups as well. And so you might be missing out on some deals by not appropriately pricing the products, or your service.
So if we combine our billable hours and our billable rates, now we have our revenue per individual. So again, this fluctuates month over month, but it's just, we can use this to build out that top line revenue by multiplying this across how many full-time equivalent employees we have. So all of a sudden, now here's our 3.5 million in revenue.
Yeah, and again, this is the important thing, is understanding what your team is built for capacity. Michaela
Mm-hmm.
mentioned full-time equivalent. That could be, you've got an individual that is both in production and in marketing. That's probably half a person. So half a person would go in here, and maybe you've got another person that's half in admin and half in production. So that's another half a person. So you have to add the half of people in there to get to that full-time equivalent. Is what we look at when we do this. Doesn't mean you have to do any funny math in your accounting system. It just means you just need to know where your people fall within that bucket, so that you know what your team's capacity is. As you can see, this
Mm-hmm.
has nothing to do with what we've got under contract or anything like that. We're just showing you what your team is built for, and it's important to understand that concept. Again, we're only taking production people. We're not taking admin. We're not taking marketing people in this account. Only production people to come up with this 3.5 million in this example.
Exactly. So again, this is how you just forecast out revenue month over month. So expecting that you could have a really solid February, maybe in this scenario, but preparing for low revenue in November. I am going to kind of speed through this a little bit so we can get to financial. So what should your net income be? We like to target 10 to 25% of net income, but I also think it's really important to consider your non-profit and loss activity. So if you have maybe really high debt payments, you're trying to pay off your credit cards, or you have really high distributions, maybe you want to be on that 25% of the 10 to 25%. I've been really looking at that with my clients, because sometimes they're like, yes, we just got that 10%. And I'm like, okay, 10% is good if you don't have a lot of debt that you're trying to pay off. So really looking at it holistically and not just saying 10% is good, because 10% could be pretty much break even at the same time. So we already nailed down our revenue for this financial statement. Now we're going to look at our production. So how we would calculate that is by saying maybe average salary is around 75,000, and then multiplying this by a burden rate to figure out what our production cost is. So burden rate is how much an employee cost you divided by their average salary. So different costs that would go into this might be their health insurance or their 401k match, if you offer any type of tech stipends or education stipends, and of course the employer side of taxes. So normal average, maybe around 28%, but it's really important to build this into your cost and not just expect that your only cost is the employee's salary. So again, getting around 1.6, if we would use this hypothetical scenario with 17 production members, and then a gross profit of around 53%. And that's really what we target with a lot of our digital agencies, is that 50 to 55% gross profit. This is what I consider a zoomed in version of gross profit when you're looking at it on an employee by employee basis. So if the effective cost, so that's how much an employee costs you for every hour that they're working, a production employee costs you, it should be about half of how much their effective bill rate is. So how much they are able to bring in for every hour they're working. And that's or go ahead, Hannah.
Sorry, I was going to say there is another question that I think here would be a good time for. So do you, and Jody, maybe you can answer this. Do you ever look at the effective bill rate of the company overall as a whole, like taking into consideration admin employees and not just considering the production employees?
Oh, you're saying taking into consideration the revenue divided by all employees?
Yes.
Yeah, you can definitely do that. I mean, that's a definite that's a KPI you could use, not really for building a forecast, like we're showing you how to actually build into the forecast here, but that's one you can use as a KPI to continue to look at. I think with that, if you're looking at that, you're going to look at more like a 35 to 40% rate if you're taking into account all employees. The problem with that metric is it's so difficult because nowadays you've got contractors. Do I count that? Do I not count that? Do I, you have technology tools that are driving, the cost all over the place. And so I would say the better approach is using it by production employees, but you can, and I'm not opposed to using it by, all employees if it's just used as a barometer for your business itself. But in building a forecast, you really need to stick with the production employees so you can keep all the production people on the top end there and all the administrative people and marketing people below the line.
That's great. Thank you.
I have seen it on the cost side too, where they do total cost by employee or even total cost by employee hour, just to see, is that fluctuating month over month? Is our overhead creeping up a little bit too much per person? So that's good to measure, I think, also. In this next slide, we're going to talk about what we should put in our overhead expense categories. And I think this is so important because as a CFO, I'm constantly recommending different percentage of revenue targets. So maybe for admin, I'm going to recommend that they keep that as 25% of their revenue, maybe marketing 7 to 11% of their total revenue, and facility, I think it's like 3%. But if I have a client and they're throwing stuff in production and one day it's in marketing and next day it's in admin, I want to be able to measure them against other clients in the industry too. That way, if they're overspending in marketing, I can say most clients are in this 7 to 11% range and try to help them find opportunities to cut costs or maybe even find more budget if they need to increase how much they have in marketing. So here's some just examples of different costs that we would put into admin, different costs that we would put into marketing supplies, professional fees, some subscriptions. And then, of course, your facility is going to be your rent, your building repairs, and some utilities. And again, it's just important to put these the same way so we know where to make cuts if needed, and we know what normal looks like for a digital agency. Another part of this is the owner comp. So it's important to make sure you know how to allocate out your expense. So maybe you do 60% production work, 30% admin, and 10%. You don't have to split up your pay and put that into the profit and loss like that, but you should be able to do a back of the napkin calculation to just make sure you're still in that ideal percent of revenue targets if you were. So if you're doing lots of marketing work, maybe your budget for marketing is closer to that 7% because you're making up for some of those expenses there. So that gets us to operating income and owner's comp. Here's some data from PayScale that kind of says the average that we expect for different roles. So you can see CEO here with about 1 to 4 years of experience, maybe the 110 range, and then up to 20 years plus around 188.
Yeah, and keep in mind the reason why we're showing these, and there's a COO, I think the CMO, and then maybe the CTO are the ones that we pulled from here, is that depending upon where you are as the owner, what you don't want to do is you don't want to fake or dilute your net income. So let's say that you're pulling out for $500,000 a year, which is perfectly fine. Your net income may not be as large as somebody pulling out $100,000, a year. So you don't want to fake out your bottom line percentage. And so the key there is that you want to normalize it again on the back of the napkin, as Michaela said. Don't put this into the financials. But if you know that, hey, that the average is 150, subtract your 955, your operating income, minus the 150 versus the 400,000, so you know exactly what your net income should be on a comparison basis to other folks that are in this world.
I think another point to make here with owner comp that I typically see is, especially if selling your business is on the horizon, is making sure that you're taking this into consideration, because whenever it comes time for a seller to evaluate your financials, they're going to look at likely what it's going to take to replace you. So they're going to look at from an average salary perspective on the market and plug that number in. And so if you're skewing that a bit one way or the other, then you're going to need to take that into consideration if that's part of your long-term goals, is making sure that you keep that in line with what you can expect a buyer to look at in that, and from that perspective.
Absolutely. So we have made it to pipeline, and I like to think of pipeline as really truing up your capacity versus sales. So we look at contract to capacity, how much work do you have booked, divided by how much work you can do, basically, how much capacity you have. So if you remember earlier in the production metrics, we kind of said based off of how many working days and taking into consideration holidays, that gets you to your revenue capacity per month. So this is just an example. If we were to chart out how much revenue we think we can work or receive or recognize, I guess, over the next 3 months. So different deals, maybe you're working with an Apple or a BP, we can calculate contracted revenue at this bottom line here, adding everything up, and then we consider our capacity. So maybe in September, your contract to capacity is pretty high. You're 91% booked for how much you think you can do. And it's pretty normal to see this taper off towards the end of that 3-month window, just because you don't always have line of sight to what work is going to actually land in the month. But we use this to true up our forecast, and we never want to assume we're going to be at full capacity month over month, because that's just not realistic. So monitoring your contract to capacity percentage month over month when you're looking at pipeline just shows the health of your pipeline, and it kind of gives you a heads up if you need to make some really tough decisions. Or maybe on the opposite side, you are way over your capacity is running out and you need to find some contractors, or maybe make some hires sooner than later.
Yeah, and I think it's important that Michaela mentioned, really, you only look into the next 3 months. I mean, it gets really fuzzy math once you get past 3 months. And so, again, we're creating the forecast based on the capacity of the team, and that revenue capacity numbers are the ones that we calculated earlier, the 276, the 317, and the 184, totaling the 778. And then now we're showing up to truly what do we have under contract and what does our pipeline look like. And the rest of the conversation Michaela's going to do, we're going to go through it fairly quickly. You'll get a full recording of it, so you can kind of listen to it. But there's a lot of formulas in here. Don't worry about the formulas. Don't bore yourself there. But there's ways you can calculate this. Very, very simple, and using the average cycle, the average length, and so forth, and sliding it into in this example, for instance, here, if we took the revenue capacity less what we had under contracts, we know in the next 3 months we've got about 500,000 under contract, and then going through the formulas based in here, saying, hey, we've got, if you back up real quick, one slide there. The variables that we use would be the average sales cycle, the average contract length, and the days left in the period, as well as the closing ratio. So those are the 4 main things that you've got to make sure that you understand where you fall in yours, and know what your numbers are, so that when you're calculating this, you've got a good number to calculate. And so going to the next one, we're just assuming those averages, 60, 90, 90, 90 that we looked at earlier with a 50% close rate. Your pipeline needed in this example, you're going to need about $354,000 in your pipeline in order to justify that the forecast is accurate. And so going to the next page, we throw some examples in here. There's a 354. If we just tweak these numbers a little bit and say, hey, days remaining in the period is only 30, so meaning, hey, we're not looking at the first day of the quarter, but we're looking at the second month of the quarter or the third month of the quarter, how much we have left in that quarter to do. You can kind of see by just looking at, if we only have 1 month, of course, the pipeline's got to be bigger. And so in this case, the pipeline went from 350 to $1 million. If we change the average sales cycle, so we actually worked on that sales cycle, we followed up quicker, we were able to actually dial into that and figure, hey, we can close deals quicker now. You can kind of see, well, then the average goes from 354 to 177 in the pipeline. So you can kind of see how these numbers really do impact what that pipeline is going to look like. And so I think we have another example, which is the average contract length. And so if your typical contract length is 6 months or 3 months or 9 months or whatever that might be, you need to make sure you slide that in here as well, because contract length also makes a huge difference. And so in this example, if our contract length went from 90 days to 180 days, which is a great thing, but just keep in mind, it also means that you need a bigger pipeline in order to substantiate that. Because once that contract falls off, it's going to be hard. There's going to be times in there where you're not going to have anybody, or your capacity will, everything, you're going to have a lot of work to, not a lot of work to do within that to fill the time. So you can kind of see it went from 354 to 700,000. So
Great.
again, wrapping things up, we've got the 4 different things. We got cash, production, financial, and pipeline. All 4 are critical within this profit-focused accounting concept. You need to have enough cash in the bank. The production, you need to be able to build that dynamic forecast and look at it on a regular basis. We showed you how to build it. One thing we didn't touch base is you really need to look at it and compare what actually did happen in those months and kind of spread that over what's going to happen. So you created the forecast. Now you just have to look at it on a regular monthly basis and make adjustments. The financial side of it, we talked about. And the nice thing about, if you put everything in the buckets that we talked about, production, the operating, marketing, and so forth, then you can kind of compare to your next door neighbor and see, hey, how are we doing compared to the industry? It's a really nice checkup there. And then, of course, the pipeline, which we kind of breezed through a little bit, but that's the one that's tying everything together. We created it based on capacity. Now we're going to shore it up based on what truly is going to happen over the next 3 months, or what we think is going to happen over that next 3 months. With that, Michaela, appreciate that. You did a great job covering this. Hannah, like always, you're awesome. Want to go ahead and cover the rest of this?
Yeah. So Michaela, the slide that she was just on is the QR code to the recording of this presentation in its entirety. So if you have more questions, if you want to listen to us spend a little bit more time on some of these, just scan this QR code. Again, you're going to get the copy of these, so don't worry about trying to grab that really quickly. On the next slide, we also have a few more free resources for you. We have a forecasting booklet that you can download that might aid you in actually applying some of these concepts to your organization. So you can download that from us. We also invite you to listen to Jody's audiobook. So Digital Dollars and Cents is now available on I guess it's on Audible, everywhere you can listen to audiobooks. So we invite you to download a free copy of that. We have a newsletter that we would love for you to subscribe to that comes out each month. And then we also have a podcast specifically for creative agencies called the Creative Agency Success Show. And there are lots of great conversations and resources that can be found there. So thank you all so much again for joining me. I am so glad that you did. And yes, if you want to schedule a free virtual consultation, please do so. We'd love to talk to you more and just hear about your business and hear where you're at with that. So thank you again, and we'll see you again soon.